The Federal Reserve announced they're going to be raising the federal funds rate by 75 basis points. So in today's video, I'm going to share the actual press release from the Federal Reserve regarding this to give you some context or some insight about why they raised the rates. I'm also going to be sharing how this is affecting our housing market and also more specifically, mortgage rates. Also, stick to the end of this video because I'm going to be sharing how this increase in the federal funds rate is going to be affecting you. So I hope you guys get a lot of value out of today's video. And of course, if you do, please hit the like button. I greatly appreciate that. And also consider subscribing as well. I post frequent housing market updates so you guys can make a more informed decision about where you should be buying or selling a house right now. So with that said, let's go ahead and dive right into the video. And thank you so much for joining me in today's video. I have so much fun making these videos, so hope you guys appreciate them. Hope you guys like them. So here's the actual press release from the Federal Reserve. Again, this is from their most recent FOMC meeting that happened today. It says here, recent indicators of spending and production have softened. Nonetheless, job gains have been robust in recent months. However, inflation, of course, remains very much elevated. Therefore, the committee seeks to achieve maximum employment and inflation at a rate of 2% over the longer run. Obviously, inflation right now is much higher than 2%, and that's why they're raising the federal funds rate, of course. In support of these goals, this committee here has decided to raise the target range of the federal funds rate to 2.25% to 2.5% and anticipates that ongoing increases in this target range will be appropriate. So in other words, they raised the federal funds rate from 1.75% up to 2.5%, and they're anticipating they're going to be raising rates further as it's deemed appropriate based on the latest trends. They also will continue reducing its holdings of Treasury securities as well as mortgage-backed securities, of course. They're also strongly committed to returning inflation to its 2% objective. They also provide a disclaimer, more or less, at the end of this statement here. It says, in assessing the appropriate stance of monetary policy, the committee will continue to monitor implications of incoming information for the economic outlook. Therefore, they would be prepared to adjust their stance on monetary policy if risks emerge that could impede their attainment of their goals. And of course, these assessments is a wide range of information as well, not just inflation and employment. So they look at information regarding readings on public health, labor market conditions, inflation pressures, inflation expectations, and financial and international developments. So big picture here, the Fed increased the federal funds rate by 75 basis points, but of course they will pivot if new risks emerge. So changing gears here, what the heck is the federal funds rate and how does that affect our housing market and our economy as a whole? And here's a really good article I found on the Mortgage News Daily. It says here, repeat after me, the Fed doesn't directly hike or cut mortgage rates. So in other words, when the Fed increases the federal funds rate, it doesn't increase the mortgage rates. It doesn't have a direct correlation to mortgage rates. So what is the federal funds rate? This is basically the rate that banks charge each other in order to lend money to each other on an overnight basis. The reason why I want to go over briefly what the federal funds rate is because I get a lot of comments with people saying that the Fed's going to be meeting tomorrow and that's going to be raising the mortgage rates greatly. That's not really the case because current mortgage rates have already baked in future rate hikes by the Fed. And the Mortgage News Daily has a really good way of saying this. It says here the Fed only meets 8 times per year, but the market is trading every millisecond. Traders are not going to wait for the Fed to actually pull the trigger on a rate hike if they can be reasonably sure it's coming. Indeed, there are groups that are devoted to betting on the federal funds rate in the future, and this is called the Fed Funds Futures. And these futures typically price in most upcoming Fed rate hikes or cuts with near 100% accuracy. For example, if 7 out of 7 Fed speakers over the past month have all mentioned that they're leaning towards a 75 basis point rate hike, it's essentially guaranteed and the bond market has long since changed accordingly. And because the market can show up to the party so far in advance of rate hikes, it's not uncommon to see mortgage rates move in the opposite direction of the Fed on the day they actually raise rates. So in other words, this increase of the federal funds rate by 75 basis points today did not cause mortgage rates to spike today because it was already anticipated. And you actually can see that when looking at the yield on the 10-year US Treasury note. So as of today, at the time of this video, which is 1:38 p.m. on the 27th, the yield on the 10-year US Treasury note is 2.78% and actually decreased slightly compared to yesterday. And as you guys may know, this yield is tied directly to mortgage rates. So when the yield decreases, so can mortgage rates. In contrast, when this yield increases, so can mortgage rates as well. I actually found a really interesting article from CNBC regarding what has happened and what is expected here in the months to come here. It says the second 75 basis point rate hike from the Fed was broadly in line with what economists were expecting as the central bank, or the Fed, attempts to curb inflation. And bond yields actually fell as the Fed chair, Jerome Powell, actually left the door wide open about the size of the rate move at its next meeting in September. But here's a key point here, because Jerome Powell actually noted that the bank, or the central bank, would eventually slow the magnitude of rate hikes. It says here that Jerome Powell said that a 75 basis point rate hike in September could happen, but it would be dependent on the latest data. And here's what Jerome Powell had to say. As the stance of monetary policy tightens further, it likely will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation. He also noted that he doesn't believe we're currently in a recession right now, and the reason is there's too many areas of this economy that are performing too well. And according to Michael Pierce, who is a senior U.S. economist at Capital Economics, he says the economy is clearly showing signs of a slowdown. We expect the Fed will shift back to smaller hikes from here, with a 50 basis point rate hike in September, which would be the most likely option. So in regards to that, let's have a look at what the street is forecasting for the federal funds rate over the next couple of sessions here. So the Federal Reserve actually meets in 7 weeks from now, on September 21st, 2022. And so the current rates right now is at 2.5%. So right now, the street is forecasting by a 90% probability that the Fed is going to be increasing the federal funds rate by 50 basis points up to 3%. What's interesting about this is that before the Fed announced this increase of the federal funds rate, which was yesterday here, the probability of a 75 basis point rate hike was actually 28.6%. Now it's only 10%. Also yesterday, they were calling for a 70% probability of a 50 basis point rate hike. And now, of course, it's 90%. So that's their September meeting, again, calling for a 50 basis point rate hike. We'll have to see that changes, though, of course, because we're 7 weeks out, or basically almost 8 weeks out. But the next meeting is actually on November 2nd. They're basically calling for a 25 basis point rate hike by 81.3% probability. And stay tuned here in just a little bit, because I'm going to be sharing how these future rate hikes may impact you in the months to come. So in regards to mortgage rates today, thanks to the yield on the 10-year U.S. Treasury note decreasing slightly, basically 2 basis points decrease compared to yesterday, the average 30-year fix, according to the Mortgage News Daily, actually decreased to 5.54%, only a decrease by 1 basis point. Also, the rate for FHA loans and VA loans also decreased as well. FHA is at 5.12%, and a 30-year fixed VA loan is at 5.18%. Also, according to Investopedia.com, the average 30-year fixed as of today is 5.61%. So in other words, we didn't see as big movement in mortgage rates because the Fed announced they're going to be raising the federal funds rate by 75 basis points, because that was already expected. CNBC actually had a really good article about what this back-to-back 75 basis point rate hike by the Fed actually means for you. It says here, for starters, this rate hike will correspond to a rise in the prime rate and will immediately send financing costs higher for many forms of consumer borrowing. On the flip side, higher interest rates also means you're going to be earning more money on your savings accounts. According to Greg McBride, who's a chief financial analyst at Bankrate.com, variable rate debts such as credit cards and home equity lines of credit, or HELOCs, will be the biggest exposure. This is because credit cards and HELOCs have a variable rate. In other words, when the federal funds rate increases, so does the prime rate, and therefore the rate that you pay on your credit card and your HELOC also increases as well. According to Ted Rossman, who is a senior analyst at creditcards.com, he says current rates on credit cards right now are about 17% on average, but could be closer to 19% by the end of this year, which would be an all-time record high. So what this means for you, if you have a HELOC or if you have a balance on your credit card, this basically means you're going to be paying more in interest every month. And of course, my advice for you guys, if you can do it, try paying down your credit card balances and your HELOCs, because as rates increase, so will your payments. And because the Federal Reserve is expected to raise rates further this year, consumers should also be prepared to pay for higher rates this year as well. So with that said, if you guys got any value out of today's video whatsoever, then please hit the like button. I greatly appreciate that. Hope you guys have an awesome day and look forward to seeing you on the next video.